So we'll jump straight in. Thanks for joining this morning, and we'll crack on. So Scott, I think you were going to start with an introduction on Haatch.
Morning all. Fred, there was a bit of an echo, so it may be tech our side or not, but anyway. You go on mute, yeah? Okay, I think that's better. Cheers, guys. Morning all, I'm Scott Weavers-Wright. I am one of the Haatch Ventures partners of 4 that you can see on your screen. And I was the original kittycare.com founder, which I created in 1999. And kittycare was a online baby store, but we took the tech to another level and spent 13, 14 years building a business up, which became the biggest online baby business in Europe. And we sold to Morrison's for 70 million in cash. After which I became chief architect of the 17 billion pound monster ship, Juggernaut, and I became CEO of onmorrisons.com. I've been in business since I was 18 years old in IT, and so I'm 48 now, 49. So I've got 30 years experience in developing businesses and developing teams. kittycare was special, and we achieved 23.5 times multiple on the exit. Fred, do you want me to talk about Elevate or introduce the team?
Let's do the team, and then we'll move on to Elevate. And after we've already got question 1 in as well, so I said we would answer questions as we go. So the first question we've had come in is a really good question actually around our management fee and why we charge this to investors instead of investee companies. So I don't mind picking that one up actually to start. Kevin, in answer to your question, we want the best deals possible. So we've been in 3 or 4 deals this year alone, big Series A deal in the last couple of months where VCs won't let investors at the table who charge the investee companies. VCs don't like it. They don't think it's right for investors to charge companies. So although we do see some funds do that instead of charging investors, we see that as a huge problem on the other side actually with deal flow. So we weighed it up at the beginning and we decided the simplest approach is to charge our investors. So when we're moving in and talking to prospective portfolio companies and doing deals, we have no friction. We can land the best deals and best terms possible. So hopefully that answers your question. Should we go around the table on introductions quickly then? I'm Fred, co-founder of Haatch alongside Scott in 2013. Originally at kittycare and Morrison's, looked after e-commerce tech, particularly focused on our startup program, which you'll see a number on screen here, 3 billion in exits. So we selected very early stage technology startups, a bit like we do now in Haatch as investors, sat on their advisory boards, worked with them, implemented them. They've now all gone to exit for north of 3 billion, which has happened over the last kind of decade. A couple of acquisitions to Oracle, IBM, Microsoft, and that's really kind of the foundation for why we started Haatch. Simon?
Thanks, Fred. Hello, everybody. First chance I've had to say hello, so good to meet you all virtually. So I'm Simon Penson, as you can see on screen there. In terms of background, I guess I'm digital through and through. I've kind of been working in digital since this kind of very late 90s. Started off building a number of sites that I owned in the affiliate space and sold those. Went into the corporate world, learned lots and lots from that world, and then ended up exiting that to actually build what became Zazzle Media, which was my last sale, which is a digital marketing agency. We sold that into Public Group, listed company. Worked with those guys for 3 to 4 years as part of an earn-out. That ended kind of back end of last year. In the midst of that, became an angel investor and got to know certainly the majority of this team here kind of from about 2013, 2014. Angel invested together, and then obviously latterly in sort of the beginning of 2018 we formed ventures predominantly to allow other people to invest alongside us. So yeah, that's a bit about me.
Hi guys, I'm Mark. Thank you for joining today and listening to our story. I'm based in Singapore. I work for Google, been at Google for about 5.5 years. The last 2 years here in APAC, leading a partnerships team that run a business called Devices and Services. So this is Google's hardware business, our phones, our speakers. We bought the Nest business a few years ago as well, so security cameras and smoke alarms. And the other part of the business is digital services. We have subscription businesses around security, a gaming subscription business called Stadia. And I lead a partnerships team across pretty much all the major markets in APAC. Before I moved into this part of the Google business, I was the business lead internationally for a business called Google Play, which is another big business, a very big business, which is about content, apps and games, where I work closely with the developer community to help grow their business across all the international markets that Google Play. So Google Play is the App Store equivalent on Android. So I get to see a lot of interesting trends, both from an APAC and a global perspective, across digital content and most recently around ecosystems and hardware. Before I joined Google, my background very similar to the other three, very digital focused. It's a mix of media and retail and technology. I worked at Tesco's for a couple of years running one of their digital content businesses. Before that, I was head of digital and cross-channel at Sainsbury's. Before that, I did a startup that I sold into Sainsbury's. And then before that, I worked at Microsoft for 5 years. And previous to that, I worked in the music business for EMI Music and Warner Music. So my background has really been content and then how technology affects content and then the consumer interaction. So that took me into the retail space as well.
Thanks, Mark. Fred, I suppose I should touch on Elevate. Elevate was my second exit, and ironically, I actually did this in parallel to Haatch. So in 2014, when it became apparent that Morrisons were imploding, unfortunately in the UK, I dragged and picked 20 of my best engineers from the kiddie care days out of kiddie care and out of Morrisons and created Elevate. Elevate was a monetization platform, a bidding platform that allowed brands and their agencies to bid and raise the product profile on the retailer website. So if you think about Iceland, Morrisons or a grocer, it allowed Hovis Bread to effectively place their product in the search results in a more prominent position than maybe the own brand bread. And we scaled that business over 4 years. Wonderfully, we had that wonderful call from Silicon Valley in 2018, and the business was sold to Quotient Inc., who are listed on the New York Stock Exchange for a considerable amount of money, which was wonderful, and we received an enormous return. And very proud moment for the team, because they were the original KiddieCare engineers who built KiddieCare.com with me, and it was lovely to do it again in parallel with Haatch, and it was wonderful to receive Haatch investment as well. So it was a great exit all around.
So the last thing I wanted to touch on before we move on is this line at the bottom of the screen, which I'm sure people have seen. Obviously, we come from an angel investment background and have been investing ourselves for the last 7 years. So part of our whole proposition at Haatch and something we think is pretty unique in the market is investors are truly investing alongside us. So we currently make up about 22% of the fund. So we invest in every single tranche. So investors and your clients are truly aligned with us, and we're truly aligned with them investing alongside us. Moving on to our portfolio and our focus, and I'll let the other guys call out some success stories here. But I guess the overarching kind of draw that brings all of our portfolio together is we're focused on digital companies. So we're investing in digital companies that are disrupting markets. So that may be anything from Buy Me in on-demand grocery to Eleanor, which is transforming how luxury resorts manage their guest experiences, to Marvel, which is helping designers create prototypes. I'll let Scott, Simon, Mark call out a couple of recent success stories so you can get an idea of what we've been up to.
I'll go first. And I've got, I'm not going to say my favorite because I can't have a favorite child. And my daughter has gone into labor this morning, everybody. So I'm due to be
exciting, mate. Very exciting. Good luck.
So she's 42 weeks and she's due to go into labour. So the missus is there. And yeah, what can go wrong? Look, it's very difficult. Marvel was our first in 2013, 2014, and Marvel is a beautiful prototyping technology business, which is now valued at, I think it's just over $25 million. And we went in at 600 valuation. So we tend to pick founders who are disrupting markets. Our most recent disruptor, who is tearing up trees, must be Buy Me. Buy Me is an on-demand grocery delivery business based in Dublin. We went in 3 years ago when they were at £10,000 a week. They are now in excess of €1 million a month, and they've just landed a huge Series A check from a very prominent London VC, followed by another 2 or 3 VCs in Ireland, and of course Haatch. And Haatch led their first 3 rounds. And at some point, we tend to let the bigger boys come in and lead the next stage and value the business and validate our philosophy. And that's what's happened with Buy Me. And they've got a valuation now in excess of 20 million. And they've just launched in Bristol. And they are raising a Series B. And thereafter, they are launching in 10 cities around the UK, going after 2.5 billion volumes of sales. So a real phenomenal business which delivers your grocery within an hour to 3 hours, however you decide. And that's at the moment Tearing Up Trees, Fred. So it's probably one of the ones I'll reference.
Yeah, and Simon, do you want to touch on Poplar maybe, which has been a really successful story for us over the last?
It's funny enough, I was literally just writing that down actually, because I think, obviously we're excited about the ones that are really scaling fast and are really big news. But actually, for me, what I really like is the fact that I think across the board, we've managed so far at least to kind of partner with a number of businesses that are actually really doing well and have continued to do well through this kind of precarious period, obviously, that we're hopefully now exiting. And I think a lot of that is down to the digital focus, but also the way that we spend a lot of time asking the right kind of questions, particularly of kind of founding teams, because we invest very early relatively. And obviously having been there and bought the t-shirt and wearing the scars between us, we kind of know what it takes to kind of drag these things out to, kind of the scaling process. So actually I could talk about almost any of them, but Poplar is probably one that personally I'm really, really interested in. It was one that I was very heavily involved in when we were actually working through the pipe and spotting it. And in basic terms, it's actually a relatively simple content business, but actually because it's in VR, AR, so obviously virtual reality, augmented reality, it feels very cutting edge. But inherently, all it's doing is really kind of providing a marketplace for brands and anybody else that wants to create that kind of cutting edge content in a really easy way. And I think the brilliance of the founding team there, headed by David, who's kind of ex-Google, and Mark knows, is that he's managed to take something that on the face of it can seem very, very complex and actually created a really, really amazing community of developers, designers, creators, and enabled brands to be able to create augmented and VR content really easily. And, I think that kind of it's the simple stuff that's kind of hard to do right. And I think that's the genius of that business. And obviously, as you may well have seen in the press, in the last couple of weeks, they've just raised another round. We invested in them kind of just over a year ago now, and they've already raised a significant up round as well, with some exciting new investors coming in. So sky really is the limit for that one. So yeah, that's definitely a plus one for me, Fred, for sure.
Great. We've just had a question come in from Kevin on failures. So it's actually a good point. So whilst we talk about our successes, those of you that have already got our IM, and obviously if you haven't, we'll follow up after this call. We also talk about failures to give you some balance. So we've lost 3 businesses, that's it, in our entire history of Haatch, dating back to 2013. All of them are investments that Scott and I made under Haatch Angel before we launched Haatch Ventures in 2018. They all are very similar in a few ways, actually, which we've taken a lot of learnings from. So all of them were single founders. So something that you'll see if you go on our website and look at how we ask startups to pitch to us. We have a very strong focus on founding team and how they work together. Secondly, they were all consumer-focused businesses. So they required a lot of cash to get off the ground. And although we actually made very small investments in 2 of them, they're the 2 of the smallest investments we've ever made at £30,000 and £40,000. We now look at a runway and how much cash a business needs to scale to make sure it has enough to get to that crucial next stage. And secondly, one of them was in America as well. Obviously, we're an EIS fund. We don't make investments in America. That was a personal investment for us, but we couldn't provide them the support that we needed to, and we couldn't be as involved as we needed to. So they're the 3 failures we call out. Anything?
Yeah, Fred, I think some learnings we made from that, what I certainly did was, I don't know if you mentioned it there, so forgive me if you did, was single founder. We make a huge effort now to only invest in dual founder or bigger groups. We can't support a single founder when they're in trouble and they've got too much to do and they're chasing the dragon. But we invest in my learnings is we invest in a bigger group.
Yeah. Kevin, don't be sorry for asking another question. I'm not going to skip over it, but we've got a slide on it, so I'll pick it up when we get there in a bit around our upcoming close at the end of this month and businesses that we're looking to invest into, and interestingly, ones that we may not invest into. So we'll pick that up when we get there. We very quickly wanted to touch on this. This is something that's very important to us, and you'll see we call this out in our IM around world-leading VCs following us. So again, we think this is very unique in the market. We are picking companies at a very early stage. We're backing them and working with them very closely. And of course, a goal is for them to go and raise Series A, which tends to sit at 12 to 18 months after an investment from us, maybe a bit shorter, maybe a bit longer. And as you can see from this slide, we have some of the biggest funds in the world following us into our companies at a later stage. Everyone from Index Ventures and Notion and Episode 1, who I'm sure you know in London, to the Wheatsheaf Group, who have just led a huge Series A in Buy Me, to Amazon that have just invested in Veritonic from an audio platform perspective. So really great group of VCs that follow us into our portfolio companies at a later stage.
Fred, can I just ask Mark, because Mark's obviously a key guy in the group, from out there in Singapore and seeing it all, and it's amazing. On our portfolio, Mark, is there anything that you are particularly excited about?
Thank you, Scott. I wonder why Fred had left me out.
Sorry.
I'm going to pick 2 favourites. My current favourite is Buy Me, just because I like they're a great bunch of founders, but I like a team that is lucky as well as getting their timing great, and they've done an excellent job in Ireland, and I can feel the momentum will start to build in Bristol as they expand in the UK. And clearly, a business that gets a Series A has got to be very very light at the moment. So, well done to Devon and team. I think they've done a great job. And Buy Me, there's been a lot of history there. I mean, what is it, 2.5 years since we first started that conversation, and they've been really fortunate with the timing of COVID. But I would also pick on ViewPay, and ViewPay is a pay-per-view video platform that allows almost creators or content owners to connect one-to-one with a paying audience. And this is something that platforms like Twitch and YouTube have been trying to solve for and haven't got right. And there's lots of really strong benefits to YouTube. Obviously, I know YouTube incredibly well, and Twitch, which is owned by Amazon. But ViewPay, what I like about them is that they're a really hungry group of founders that have gone there and done it already with another business, and they've got a very clear vision of where they want to get to in terms of connecting creators with an audience on a one-to-one and a one-to-many paid basis. But similar to Buy Me, their timing is great. I mean, clearly a lot of people are not going to gyms, a lot of people are doing classes. What's that? Is it Joe Wicks? I haven't done any of his classes. Scott, you probably do them quite regularly every day, yeah. But the kind of Joe Wicks phenomenon, these guys, we started talking to them again a few months ago before COVID really got going, and their timing again is excellent. And there's a theme. There's a couple of other video partners, startups we're looking at. One around interactive gaming, which is another really a really high buzz area at the moment, where people are starting to want to influence the way that content actually goes, get involved in the content as it's being live broadcast. And you're seeing this with kind of tipping within video gaming creators, but particularly in terms of controlling the feed and quizzes while you're actually watching the content. So I think this video space is very, very exciting at the moment, especially with people in isolation and using a lot more video to connect and to find the content they like. So I'd add ViewPay into the mix.
Sorry, Mark, I wasn't leaving you out on purpose.
No, we'll pick it up in the partner call, next partner call.
But I actually have a question from Martin, which I'm going to send your way, Mark, which is,
good question.
Do you have an example of one of your portfolio that's demonstrated nimbleness over the last few months?
Oh, yeah, Eleanor, I would pick out. I think I think Eleanor would probably be the best example. I don't know, you guys tell me if I'm wrong. Eleanor, as Fred described before, is targeted the luxury hotel market with a really strong base in the Maldives, but they're expanding internationally into a lot of markets, particularly across Europe. Now, clearly this market has been severely smashed up over the last 6 months with COVID. What the team there have done is pivoted to break up their product a bit into smaller modules, but also have a deeper engagement with some of their partners and prospective pipeline partners in terms of a freemium model to get it built, to get it introduced into the hotel and introduced to the team and integrated into their business while they're in a real downtime. And I think it's great to see how the team has dealt with what could be a critical slowdown in their sales pipeline, but actually pivoted to actually now it looks like they're going to come out of the COVID lockdown and the real slowdown in the luxury hotel market with a much broader base of partners that will start to come online in terms of fee paying towards the end of this year and early next year. So that would probably be my most relevant article example of a pivot.
I think they realised that their product is very, very sticky. So if it's in place, once it's in situ, they managed to hold on to those customers for a long, long time. So this obviously proved to be a really great opportunity for them to do that and actually just get the platform installed and unlocked more properties. And they've done an amazing job.
You just don't know the business. These guys, value-added services, so booking a spa. But the idea is that you book a lot of your experiences before you get to the hotel, and you actually build up and get excited about your holiday experience before you go there. And their metrics for the dozen or so hotels that they work with in Maltese are incredible in terms of increasing the ARPU per resident. And so by starting to do that integration work now, while hotels are in a kind of reassessment, it's actually worked incredibly well for the sales pipeline when you thought it would have been the opposite. So kudos to those guys, they've done a great job.
Yeah, and I have to add here, guys, this is where smart money and we come into play from a board seat point of view, because Eleanor, we're in a tricky spot. And let's face it, is in a tricky spot. And we helped them and advised them to land grab. So no customers were doing anything. They had prospects who were doing nothing. And the team from Eleanor came to see us and said, what do we do? Because we have a burn and we have a burn rate. And if people don't know, we encourage our startups and our scale-ups to go for profitability and cash flow, break even, and therefore generate their own cash, because we don't want them to be reliant on us or VCs. And so Eleanor came to us and said, we got a problem here. And we encouraged them to land grab, and which means in English, start to give away the product free of charge. They had 10, 12 customers already, as in hotels, And we said, go and give it away free of charge, because this is the moment hoteliers do not want to pay anything, but do accept that in theory, the product will be there once they're open, and will buy into it. So they did, and they've actually gone in and added 6 more hotels, including some in Europe, to their platform. And once they switch them back on, and we've assumed they'll all come back online in December, January time, they will be profitable, which is extraordinary. And that's what we bring to the table.
Great. So we move on from portfolio. I think we covered this slide when I.
Right. Can I just say something about this slide? So I'm going to be a bit cocky. We've been doing this since 2013. We're very early. We're far earlier than these folks would even dream of going into businesses, because we spot verticals, disruptors, and obviously founders early, and we support and we write checks. Historically, we've been ballsy enough to write our own money and our own checks. And these folks have followed it. So BGF have put 4 million plus into one of our scale-ups. Wheatshift have put 3 million plus. Audio is obviously Amazon have gone into one of our American companies. So we, Index Ventures, 2 million check. So we have the balls to go in early, but we don't throw away our money because it's our money. And now we run an external fund called Haatch Ventures. We still don't throw away our money because we invest alongside. So we're not a spray. We go into each business because we think it's going to work and provide the returns for us and our families, and obviously for the founders. And then these folks turn up and say, wow, what a brilliant business. Can we come in? And these are generally Series A checks, Fred?
Yeah, generally Series A. We typically invest at kind of pre-seed and seed stage. So these tend to follow 12 to 18 months after us. So we're definitely picking them up a lot earlier on the journey. How do we achieve 10x returns? So Simon, Mark, I think this would be a great area for you to cover. Simon, you're particularly focused on our pipeline and DD process at the moment. So maybe we start there and then we move on to kind of our approach and how we support companies.
Yeah, sure. 10x, yes, is a brave target, but I think to Scott's point, that's kind of where we want to live. And one of the key reasons for that is because we go really early. It's the only real way of being able to achieve those kind of numbers. But again, as Scott kind of points out, we spend an inordinate amount of time. I mean, it's basically my full-time role to spend on looking at our inbound pipe. We are very lucky in some respects that, we get a huge amount of inbound because of the brand that we've built collectively over the last few years, and obviously Fred and Scott before that. And so, last year, for instance, collectively we looked at just over 500 pitches. So, that's the kind of quantum that we're talking about here, and yet invested in 6, Fred, something like that. So, you can see there that there's a huge amount of due diligence that goes through, and that usually starts with obviously kind of a quick read through of kind of pitch deck, etc. One of the partners will then pick up an initial call. We'll spend probably an hour and a half with that founding group. Ask some very specific questions, understand a little bit more about the business and the opportunity and their big vision. So some pretty basic stuff to begin with. But then obviously we then take that to our kind of weekly partners calls with a view to then kind of digging deeper and, saying yes to some and no to others. And then we kind of follow that process for, perhaps a month or so really in terms of that commercial DD piece before then we go, okay, this is definitely something we want to take further and, offer a term sheet basically and go from there. So, we spend a lot of time, and I think uniquely we are able to think about those potential opportunities slightly differently to a lot of people because, again, we've been there. We've built and scaled, our own businesses from, the corner of our front rooms and offices. So we understand the unique set of skills and, quite frankly, the pig-headedness that you need to actually get through that pretty horrendous often initial couple of years. And not everybody's cut out for that, as great as their idea may be or as great as they may be. sometimes it feels
I think you're spot on, Simon. Sorry to cut you off.
No.
I used to employ 2,500 people, but I started off with one. When we grabbed Elevate and the engineers to form Elevate, we had 20, not 2,500. You've got to be prepared to be in the trenches. You've got to be prepared not to think blue sky, but actually, build a business from scratch. And from a technical point of view, guys, I think it's important to remind everybody is that the tech team we have in the business is pretty severe. I was chief architect of Morrisons.com, which was a £17 billion organization, and chief architect of their entire business. I built the kiddie care platform. Kiddie care was a reference site for IBM and Endeca and Microsoft. So we spoke to folks who were trying to buy or thinking about buying IBM products, and we were a reference site for IBM. They referred to us. And when it came to Elevate, we built that from the first line of code up. So when we would jump into businesses and they say we've built something or we're thinking about building something, we have a lens that we can look through, both commercially and tech. We are very smart money. We don't have the wool pulled over our eyes when it comes to technology or the commercial opportunity.
And I think that's exactly it. And what I really enjoy about the process, actually, personally, is the fact that I have, if there is a startup that comes through that isn't front and center kind of my heartland, my background, I guess broadly speaking, is tech, yes, but more audience growth, digital or marketing, advertising. So obviously I can see through that kind of acquisition piece and understand that brand and all that kind of stuff. But if it comes to deep tech, then I can pick up the phone and say to Scott, what do you think of this? Off he runs. Likewise, if it's really about the kind of technology scaling piece, then Mark is there are a few people better connected, and I think that is again a really unique kind of offering that we have that kind of broad range of still very focused digital skill set, but we're able to kind of pull ideas around really relatively quickly.
The only thing I'd add is I think as we go through that DD process, I think we really try and get to know the founders. I mean, Scott spoke before about single founder risk. We tend to gravitate to two founders, but we have invested in more than two founder startups. It's not that we try and find people we just like, but we have been fortunate enough to connect with a lot of them. But I think in the DD we pull and push them a lot. And really look for that intellectual rigor and flexibility that they can handle some of the questions and challenges and be prepared for their business plan and their business model to pivot. And as we go through that, we get a feel for are these the kind of people we want to work with? Yes, obviously we've got to love the problem they're trying to solve, love their vision of what they want to do in terms of how they want to change an industry or change a vertical. But we build a relationship because we're trying to help them succeed as well as kind of make money and look good at the same time. And that builds a foundation for the last couple of bubbles on here. We get a feel for them, we get to understand them and their concerns and get a relationship going. That means that we can get a lot of transparency with them. The example we used about Eleanor with Darren is guys, I don't know what to do. I think the other bit on there, Darren's pivot, was we really helped him think about Mandarin because we thought we actually had a gut feel that some of those resorts in the Maldives might open up as China only in point-to-point air bridges. And so building that relationship, I think, means that we have a lot more emotional capital as well as the intellectual involvement in what they're trying to do. And that helps us when we take them back to other VCs for the further rounds, because we're completely nailed on in terms of our understanding of the business and understanding of the individuals. And so I think smart money is about technical DD. I think smart money is asking the right question, understanding the kind of the evolution that's going on in some of these areas. But I think the personal piece of it is really important. Yeah. At least it is for me, guys. I don't know.
I actually enjoy DD at the moment because we are picking some brilliant businesses and we have found some brilliant. And it's wonderful to actually get pushed back by a brilliant founder who's not going to accept your point. And you a hard time. I'm just going to pick up on ViewPay, because ViewPay is one of the most exciting investments we have.
Yeah.
But we've delayed it. And I think I've been a bit of a ruckus here. We've delayed its launch until next week. I think it's launching, Fred, in a week's time. It was due to launch a month ago. And from a tech point of view, not particularly from a tech point of view, but from a customer journey and a user interface point of view, I had some real challenges around a couple of logins on it. And I just thought, this is not going to be a beautiful, seamless thing. And I pushed back. Now, to be fair to ViewPay, they listened and learned and have produced a better user interface, and it will launch next week rather than a month ago. So we're not afraid of stepping into a business to say, I'm sorry, we don't think this is good enough. Can you just hold fire and make it better? And these are the levers to make it better. So we don't just chuck in grenades. We do offer a lot of assistance and help, both commercially and technically. But ViewPay is super exciting. Live pay per minute streaming for entrepreneurs who need to work from home, be it a plumber who wants to, who you can now speak to and pay 10p a minute for some advice, or £1 a minute, whatever the plumber charges, on a one-to-one or one-to-many, is hugely exciting. And ViewPay had the balls actually to say, I tell you what, Scott, Fred, Simon, Mark, you're right. We'll just get this right, and then we'll push it back. We'll push launch back 2 or 3 weeks. So good for that.
We've just had a great question come in actually on stuff.
I was going to say, Kevin Wilkes is winning the Q&A leaderboard. He gets a Haatch mug.
It's a two-part question. So the first part is around, do all 4 of us mentor the companies? Can each of us cross over to each company to provide board presence, and so on? So in answer to that, the answer is absolutely yes. So we take board seats in the majority of companies. At a very minimum, we have a board observer seat, but 90% of our companies, we have board seats. They're actually held as a corporate director under Haatch Ventures, which means from a legal perspective, each of us can attend a board meeting. So we shape board meetings throughout the year around topics. So at a minimum, we ask our portfolio companies to hold 6 board meetings a year, and then we shape them around certain topics. So BuyMe are holding a board meeting next week. One of the key topics for the discussion is marketing and UK expansion. So that's a great one for Simon to attend. So we'll all rotate in and out of each company, which means that we get the best out of our time with them and they get the best out of us. The second part of the question was on Keyman Insurance and how we cover founders. We do this in a couple of ways. One, Keyman Insurance definitely comes into play as the company continues to grow. It's something that we're continuing to bring earlier on in the journey. So the majority of our companies do have that in place. Secondly, it's back to the point we made earlier, really, around single founders. So we don't invest in single founders. That's part of our investment policy. So all of our investments have a minimum of 2 founders, and in a few cases 3, and they also have senior teams in place. So we identify challenges before we invest, and then look to fill those gaps and support them. ViewPay is a prime example, really. A couple of founders, they've known each other for a long time. They've been using an offshore development team to build their MVP. Now, since investment, which only closed 6 weeks ago, they've onboarded a development team, including a CTO who's joined the management board. So we've plugged that technical gap. We stepped in for that 5 or 6 weeks before we brought him on. Same with broadcast acquisition, marketing, and operations. So we are investing early. So you would expect us to invest in companies where there's only a couple of people, but we quickly kind of fill those gaps and expand them. We will move on. I'm conscious of time. Something we really wanted to get across, which I think we've covered already, really, was around COVID-19. Obviously, it's a topic we should cover. Of course, we find ourselves in a very interesting position. But from our portfolio, we actually think we're in a pretty unique position. So we've had no layoffs. There is nobody on furlough. Our portfolio employs north of 1,000 jobs. Every single person of those are still working. We think there's a few reasons for this, which we're calling out on screen. So as part of our DD and investment, we're very focused on revenue. So we're looking for businesses that have a clear path to, of course, we invest pre-revenue, but a clear path to generating revenue, break even, cash flow positive, and so on. Secondly, we always look for a minimum of 12 months runway. And if there isn't 12 months runway, we look at scenarios where we need to make sure there is, and that's either, of course, becoming break even or a follow-on investment. So we've already touched on Eleanor earlier on the call. That's a key example of there wasn't quite 12 months runway. He had this land grab opportunity, which is the next point, to go after the resorts during COVID. So we made a follow-on investment. Poplar had 9 months runway. They've just landed a great seed round, which actually gives them significant scale and growth opportunities to 10x the opportunity where they are. And then ViewPay and other companies you've heard us talk about kind of cover that last point on screen around digital consumer and how everybody is now being forced to move online. This webinar is a prime example, and I'm sure everybody is spending a lot of time on Zoom at the moment, or similar platforms. So ViewPay and pay-per-view is a prime example of that.
It's probably worth, Fred, me mentioning as well that we actively share quite a bit of thought leadership around our thinking. So the Haatch blog is full of kind of our collective wisdoms, for want of a better word, around where our heads are at in that kind of that kind of audience adoption kind of thinking, and where we see the digital shift moving, and also how we have altered our MDD process. We like to be very kind of transparent and open in that regard. So it's really important that we kind of share that thinking as well. So you'll find all that on our blog.
And I've just got a question from Martin on directly authorised. So we recently became directly authorised by the FCA. What difference has this made? So I think it's worth calling out because I think, again, we're relatively unique in the market that we are the fund manager. It's a process that has taken the best part of 2 years to set up. It's a challenging onboarding with the FCA at times, but now puts us in a really good position where we are the fund manager, and ultimately we're not under any umbrella structure, and all investment decisions lay with us. We found that very important for kind of ultra high net worths and family offices as well. Is a key, as we're starting to speak to family offices and we started to see them invest over the last quarter. It was a key consideration for them to make sure that they were investing in the fund manager's fund and not in an umbrella structure. So we'll answer that for you. Moving on to where we're going next and opportunities that are currently available. And I know Kevin had a question on this, which we'll go back to. So we are an evergreen fund. So we raise throughout the year and close. On average, or to start, that was twice a year. Now we're starting to move to quarterly. However, we are opportunistic. So when there are opportunities in the market and we have a strong pipeline, then we will accelerate closing to make those deals happen. Our new tranche is open at the moment and it closes this month. This tranche is relatively unique in the sense that we're already in advanced DD with a number of opportunities that will likely be or will be the investments we make, and therefore we're committing to actually deploying very quickly. So some feedback we've had from advisors and investors recently is clients want money deployed and not sitting around for 12 to 18 months. So to do that, we've kind of flipped it on its head slightly. Whereas typically we would raise a fund and then move into DD with companies. We've been in DD with companies and now raising the fund that closes at the end of this month. We'll be fully deployed by the end of August, that's 2 months. And all investors will receive their digital EIS-free or SEIS-free certificates by the end of September. So tax relief is immediately available. Simon and Mark, do you want to cover some of the opportunities we're looking at investing in? And to Kevin's question earlier, some of the opportunities that we're not investing into, and if COVID has played any part in that.
Yeah, would you like to start that, Mark, or would you like me to?
Let me start Kevin's question. Opportunities that we're not, sorry, planning the fourth and close, can you confirm companies you invest in? So we'll go through that list in a minute, and that you will not invest in for any reason. Sometimes we don't invest in a business because the valuation we feel is just too far out for us in terms of us feeling like we're getting in at the right time. Actually, Simon and I have been engaging with a company for probably 2-3 months that we really liked, but they've actually just literally taken off in probably the last 4 or 5 weeks, and their valuation has gone up by 2.5 times. And we do miss opportunities. Sometimes we say no to an opportunity just because we just get a little bit spooked with some of the answers we're getting back, or whether that connection with the founders is gonna work. We've had a couple of instances where we like the vertical, we like what they're trying to achieve, but we've not quite felt like the management team is either the right balance or the right connection with us. So there's a few things that can kind of put us off an opportunity, even though we've probably put 4 or 5 all partner meetings in with each of those partners. Yeah. The 5 businesses on here. Do you want me to start, and then we'll just tag team them? So what have I got for? I've got micro mobility. What we mean by that is particularly around rental of scooters. So there's a few big startups in the US on this. But micro mobility, most of you will be familiar with the things like Boris bikes and the bikes that you see in London. That level of transport as a service, and people being able to quickly jump on a bike, and obviously e-scooters fall into that classification as well. Electric bikes are going to start coming to most of the major cities as well. We've been talking to a company that we love. They actually provide a lot of the AI backend to enable the businesses that are running those fleets to do it in the most efficient possible way. And what they're using is predictive technology that enables them, that almost like the fleet management logistics teams to be going to the right place and moving bikes. So what you don't want with Boris bikes is to have 150 in one location and 5 in another, because they have an SLA back to the London Council or to the country or city council they're working with. Sorry, say again.
TfL was the word.
TfL, sorry, Transport for London. I've been in Singapore for 2 years and I forget TfL. How can I forget TfL? Ugh, shudders down my back. But yeah, they have an SLA to those partners, and so that their technology is genius, because it helps those service companies meet their SLAs and also ensure that their people are moving to the right places and the right locations. So these guys are working globally. They've got partners in most of the major continents, particularly Americas and Europe. And we really like what they're doing. We think this is a sector that's continued to grow, and it's got extensibility into other areas. So at the moment, they're just about where the vehicles are, but as more of these vehicles become electric, it will be about other things like batteries. Again, using AI, using prediction of is it a national holiday? Is the weather going to be bad? Is there an event on in this place? Can make a huge difference in terms of the logistics company actually meeting the obligations of their contract to players like TfL. Over to you, Simon.
Very good. Yeah, absolutely. And the next one on obviously a world that we know, obviously particularly the two on the left-hand side of this screen is e-commerce. So we look at a lot of e-commerce businesses, and we turn down across the board, actually, as we've already said, and much more than we actually say yes to, or even begin any serious DD on. But I think what's really interesting about this particular one is the fact that, if we look at e-commerce as an industry, obviously it's booming now, and there's no surprises there that it will continue to do so, and this has only accelerated the adoption of that, creating more opportunity. But the two biggest challenges in e-commerce that we see are right now, one is conversion. I think, if you can find a way of really improving that, then you change the game for a lot of businesses' margins. But then after that, it's logistics. Logistics is a massive drain, and this business actually is it's a little bit later on actually than we normally look. This business has got a very, very clever platform that enables kind of businesses to very easily solve that logistics challenge. So I think that's really, really interesting, that one. And so we're relatively far down the path on that one. So, which is again good timing, but plays into what we talked about earlier around our process for picking the right industries and then the right startups within them.
The third one, we're pretty much there on the deal on this one. This is a second-time founder. Sold his first business, and this second business is actually with the same collection of individuals he did the first business, and that's a really big tick for us, because we know you don't ever want a bunch of founders that have literally come together 6 or 9 months ago. It's like bad dating in a nightclub. We know that they've got chemistry. We know that they've worked well together before. What these guys are trying to solve is a real big inefficiency in a lot of businesses, and their sweet spot target audience is businesses of like 200 to 1,000 people, and it's really built around something I'm very familiar with in Google, which is called OKRs, which stand for objectives and key results. And it's effectively what I'm trying to deliver as an individual with my team, for my manager, and they've built a platform that enables every individual within an organization to easily not only record and share the things they're trying to achieve, but record and share the blockers they've got. So it's really easy for a manager to see like what's holding up that individual or that team from delivering their objective or their key metric for this particular cycle, whether that's a week or whether that's a month or whether that's a sprint. So a well-honed team, worked together before, love the product, very, very sales focused, and like it's an enterprise B2B sale, so they've got success in that before, and they've got a really clear vision how they take this to market.
Yeah, and I think what's also really good about that business is, again, it's a really good example right now of our kind of tweaked BD process, in that, you know, what that platform does, it facilitates and solves actually a really key problem for remote working, which we know is going to be growing exponentially. In that, you know, there's a lot of platform and technology out there to help people in terms of day-to-day comms, but what I think this does really well is it actually helps manage that kind of medium and longer term communication between employee and, you know, employer, in that, you know, you can actually align the whole business to a set of key KPIs, key OKRs across the top. So I think that's, you know, that's the kind of genius in that, and why, again, timing is really good for that one.
I'm going to jump in very quickly with 2 points. One, we promised we'd finish at 11 for everybody, so we have 8 minutes. And secondly, with a question which has come in, which Scott maybe is a good one for you to answer, which is, when do you expect your next exit? Which is a great question.
Tomorrow.
Maybe we can talk about the couple that have actually been through the process recently and have decided to go again. So.
We aim for between 4 and 7 years as a range, you know, and that's our history actually. So that's what we aim for. But we have had 2 of our businesses in our portfolio turn down recent acquisition offers. Which I think is very ballsy, and I do like. But we, like all of us in business, you do like an exit to validate, but also acquisition offers are maybe the validation we need. So we have one which has been going for since 2014 in London, which has just turned down 57 million. It was a mixture of stock and cash, and it was a competitor offer, a trade offer, and they've turned it down, which I thought was extraordinary. But they, like us, think the valuation is just under double that, let's call it 100 million, and they have a route to acquisition. They know who they want to sell to, and they want to sell for cash. So that's pretty impressive. They're currently a 7-year-old business, so or 6.5, so we're expecting to get some noise shortly. And then a Dublin business, which is a brilliant solution, UK registered EIS, and they're a multi-courier solution. So in English, when I was at Kiddie Care, I used to ship 17,000 parcels a day. We built and created a pick and pack solution, which was single courier. So that was great, but it didn't give us the scale of price differential. So a parcel of 1 kilo was £3, and a parcel of 10 kilos was £3. And when you went to market, it became apparent that there was additional couriers who would do a cheaper next day service. But you couldn't create an integration for multi-courier solutions in your ERP solution. So that's big, you know, enterprise stuff. And this business has come along and effectively cloud-based and built a solution that allows 20 couriers to plug into your pick and pack solution, and it picks the relevant courier for the relevant delivery. Brilliant. And they have just turned down £28 million. And again, they feel they can get a better deal and cash. So we've supported both in those decisions. We haven't rushed them to sale, rushed them to exit. Both are scaling rapidly, cash flow positive, profitable, big teams, and we are supporting.
Simon and Mark, you've got 1 minute each on the last two that we're looking at, or in advanced DD for this next tranche. Okay, go. So fintech is number 4, and actually very, very interesting space, because I think it proves the facts, to the point earlier about, not rushing into the wrong kind of places, that we have looked at so many fintech opportunities, because, every man and his dog, quite frankly, wants to launch a fintech because of all the money sloshing around. So we've kind of stayed very, very far away, but we've finally come across one which we think is a genuinely unique proposition and a game changer. And they basically facilitate large, high volume trades between brokers and investment houses. And they've created a really intuitive platform that replaces fax machines and phone calls and creates transparency. So there's a minute for you.
Last one is in the airport industry, operating system for more efficiently running a medium-sized airport. And while you might think this is an awful time to be doing anything with the airline industry, these guys are just, again, have got a very good product at a very good price, and their timing is excellent, because the two big industry providers are incredibly expensive bespoke platforms. And this is one of the co-founders, a second time founder in this sector, so knows the industry inside out, and really targeted in terms of what they're going after, which is primarily actually about 1,600 airports, most of them in North America. They're dealing between, I think, 5 and 50 million people through the airport in a year. And really focused, great product, know exactly how they're trying to pitch it. We've got really great references, and already in some quite big airports, particularly in North America. So we're really excited about this one. We're very close to closing this deal as well.
Thanks, guys. That was 2 minutes, so perfect.
We're on track. That's good.
Okay, last slide then. Obviously, we will follow up with everybody on the call today. So you have our full IM application form, DD, all that kind of good stuff, as well as CPD certificates. We wanted to call out a few points on how we're keen to work with you. Of course, we think we're very unique in the market, given our experience and our approach, also our stage of investment. We're targeting 10x returns, which is different to a lot of folk in the market, but as you've heard today, the reasons why we're targeting that. Also, we're digital people. We want to make your life easy. So from the boring stuff is everything is online. So online application forms, online digital investor portal, which is available for both investors and advisors, allowing you to see yours and all of your clients in one place, cash and stock in real time, digital EIS and SEIS certificates. This is something that we've worked with HMRC on over the last few years. So we've been a big part of them moving from paper-based certificates to digital certificates. We now issue these within 20 or 30 days of making an investment, which is very quick, and we know our investors are very happy with that. We're also available on all the investment platforms that you use, so that may make your life easier as well. So overall, really, I just wanted to say thank you for joining the webinar today. We'll drop you an email afterwards with some follow-up material. And of course, if there's any questions, please do come back to us.
Thanks very much, guys. Great to meet you all.
Thanks, everyone.
Thank you.